Decoupling Compute from Volatility. Akash network just completed its first 90-day cycle of the Vortex burn, and the data indicates the protocol has successfully decoupled compute costs from token price volatility. In March 2026, the network transitioned to a burn-mint equilibrium, a structural shift where a percentage of every compute fee is permanently removed from the AKT supply. This creates a direct mechanical link between hardware utilization and asset scarcity, moving away from the purely inflationary rewards used during the early bootstrap years. By automating the relationship between usage and supply, the protocol aims to function as a predictable utility rather than a speculative experiment. This shift matters because it addresses the primary hurdle for enterprise adoption of decentralized clouds: price stability for long-term workloads. The minting buffer logic. The minting side of the equilibrium functions as a critical buffer against fee spikes for developers. While the Vortex burns tokens based on actual network usage, the protocol continues to mint new tokens to reward providers, ensuring that the cost of renting a GPU remains stable even when the underlying token value fluctuates. During this first quarter of activation, as demand for high-end H100 and B200 chips increased across the network, the burn rate scaled proportionally without forcing providers to manually adjust their pricing. This automation removes the cognitive overhead for developers who require predictable operating expenses. However, the system relies on a delicate balance. The minting must be high enough to incentivize hardware providers to stay online, yet low enough that the burn can eventually exert meaningful pressure on the total supply. The Vortex as a liquidity sink. The Vortex mechanism is best understood not just as a burn, but as a systematic liquidity sink. A portion of the take fee collected by the network is directed to a smart contract that executes market buys of AKT before burning it. This ensures that the protocol captures value from transaction flow, regardless of whether the tenant pays in stablecoins or the native token. Over the last 90 days, this mechanism has handled a significant increase in compute hours, demonstrating that the logic holds up under higher network load. The primary engineering trade-off here is the reliance on external liquidity. If the market for the token is thin, the Vortex market buys could create localized volatility that contradicts the goal of stable pricing. So far, the data suggests the execution has been smooth, but the true test will be a period of extreme market contraction. The signal under the noise. The first 90 days of the Akash BME indicate that the protocol is evolving from a speculative bootstrap phase into a mature commodity marketplace. By implementing the Vortex burn and the mint equilibrium, the design choice clearly prioritizes architectural stability over short-term liquidity. We see the impact of this in the way compute pricing remained flat despite the volatility seen in broader markets this summer. For engineers and cloud architects, this means the network is finally functioning like a utility rather than a volatile experiment. The real indicator to watch moving forward is the net issuance rate. If the burn rate begins to consistently outpace the reward minting during peak compute cycles, the protocol moves from an inflationary security model to a self-sustaining economic engine. The specific metric to track through the rest of 2026 is the ratio of compute hours to burn volume, which will reveal if the equilibrium can maintain itself as more high-density compute clusters join the network. Subscribe for more.